I think the market is still at the mercy of headlines in both directions. I think the one way to think about this is the setup and then whatever the trigger is. So you get setups by virtue of getting to, technically well oversold conditions, like was the case in the early part of April. Sentiment gets washed out, and that's the setup. And then you get the headline that came on April 9th in terms of the delay in the so-called reciprocal tariffs. Now we're in not completely the opposite direction. We're not at the extreme of overbought conditions as we were the extreme of oversold conditions back in early April, but we may be getting to a point where you get the setup that if you get some sort of negative catalyst, and these days you can assume that it could come from a policy perspective, you have that setup that could mean you have a bit of a move down in the opposite direction. I do think the buy the dip mentality is still very much evident. I think you see that when you see the nature of what has done well, where leadership has resided off the intraday low on April 9th. It's been in areas that are deemed retail favorites. In fact, Goldman Sachs has a retail favorites basket that has outperformed the S&P. You've seen the meme stocks outperform the S&P, non-profitable tech outperform the S&P. So it's been that retail trader bias to the lift, plus heavily shorted stocks have done very well. So short covering on the part of many institutions. So that's been the flavor of this rally, but we could now be at the mercy of any possible negative headlines.